It looks like the Fed has misdiagnosed its impact on the housing market. Things are pretty much out of control these days. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is the 9th of February. Hope you're doing well. I was off for a little bit, taking care of some things I had to do, and of course, Super Bowl was this past weekend, so we're back to it on this Tuesday. Randy Patrick here, putting the realism back in real estate. Things are moving at a quick pace in the housing market. But first of all, if you're not already a subscriber, if you could help my channel grow and smash that subscribe button, I would really appreciate that. Thank you very much. Now, I have an announcement to make here. So this is kind of timely because of where the market's headed. So I've entered into a marketing arrangement with Foreclosure.com. And why this is good for all of us, because Foreclosure.com has what? Data. And you know how I always talk about data being very important when looking for distressed properties, and Foreclosure.com has been doing the data thing for many, many years, since even before the previous housing crisis. They've got great data, they got a great interface. It's actually, it's accurate, it's timely, it's different buckets and verticals of the data. It's very interesting. Shows you on the map, shows you all the information on the property. So it's pretty cool. So I've entered into a relationship with them, which I like to offer to, obviously everybody out there to jump on board as well too, and subscribe to Foreclosure.com, because they are the leaders in this distressed property world with data as far as I'm concerned. So they do a lot of stuff out there. They're mentioned quite a bit in the media and the news, and referred to, with analysts and economists. So definitely a great relationship. I'm pleased to move forward with Foreclosure.com. And just for example here, I just pulled Broward County, and you could take a look at, there's, just yesterday's snapshot of 3,856 results. They break them down to that listing type menu with foreclosures, shadow inventory, pre-foreclosures, bankruptcies, rent to own, tax liens, sheriff sales, the whole bit. So really, if you're looking for a house as a primary residence, this is a good way to at least check things out, see what's going on in your neighborhood. If you're looking to invest, this is a great opportunity to look at data, cost-effective and accurate data, basically to start you off on your investing, I guess you could say, journey. And why I like it, of course, I just pulled a property here. You see it's already going to auction. There's a future auction sale date, and it gives you a ton of information about the property. You've got information, description, pre-foreclosure, a lot of legal stuff as well too. So you see the history, see what's going on, and basically you know what the situation is before you make offers, before you contact homeowners, etc. So as I said, I like data, and this is a great relationship that we're going to embark on. One thing I like about Foreclosures.com, you can get a free 7-day trial. It's under $40 a month, so it's cost-effective data. If you want to take a look at it, get that free trial, just go to gethousingdata.com. That'll take you to Foreclosure.com site, and you can sign up, and off you go. So thanks very much. All right, guys. Everything's working together now, and that's why I'm talking about this type of stuff. The number of equity-rich properties jumps by 2 million in 2 years, and why this is really interesting, and how could I put it? A lot of analysts or economists that are pro-housing, pro-everything is great. They want to, I guess you say, ignore what the problems are going to be down the road. Their kind of solution to all of these our problems is the fact that everyone has all this equity. So once you're out of forbearance, or once you're facing foreclosure, all you're going to do is you're going to sell it. You're going to cash out. You're going to move the property to somebody else who'll be happy to get a new property, and you're going to move on to who knows where because of all this equity. Well, you know what? There's a lot of equity out there, but it's going to be not across the board. It's in pockets of the country, and not everybody's going to be able to jump into their equity and solve their problems. It's simple as that. So we're going to see some shifting going on here. So basically, what they're talking about now is, about 30% of the 59 million mortgage properties across the country qualified as equity rich, which really means they have more than 50% loan to value. So their equity is greater than their loan by over 50%. So that's great, I would suppose, if you can get rid of it. So ultimately, I'll bring this map up a little bit higher. We've got all this equity, but funny enough, we still have underwater homes, and this is the dichotomy of the marketplace. So states with the most and least seriously underwater homes. So if you go to the West Coast, we can see that those are the least underwater homes in the dark blue, which means there's no equity. And then the lighter blue, you've got states that really have a lot of underwater homes, and those being looks like Louisiana, Mississippi, Arkansas, West Virginia. I think that's Iowa up there, and pretty much Utah, Arizona, California, Oregon, and Washington State have the least serious underwater homes. So we know that the West Coast tends to drive the equity, whereas certain states, for various reasons, have less equity. And when we talk about underwater homes, we'll get into that in a second here. A lot of these are still lagging from the last housing crisis, so they're still underwater for all these years. So it's not a good scene for some people that are still out there. So why we're talking about this? Because I can tell you that every so often you've got Adam Data Solutions puts out their home equity and home equity and underwater home report, which will sort of delve into right now. Ultimately, in the end, if we want to take a look at it, as I said, 30% of 17.8 million residential properties are basically equity rich, and represents 30% of the marketplace. Whereas the difference being that 3.2 million, or 1 in 18 mortgage homes in the fourth quarter of 2020 were considered seriously underwater. Now, this is a quarterly report, so we see, and we should be seeing, if equity is rising, we should be seeing that underwater number, going down. But it seems to be plateauing in the 3 million plus area. So we're not seeing it. It hasn't dropped below 3 million for the past few quarters now. Now they're talking seriously underwater. So what does seriously underwater means? Well, according to Adam Data Solutions, seriously underwater means that your mortgage is actually 25% greater than your home value. So, for example, if your fair market value of your home is $100,000, then your mortgage is worth $125,000. You see, so really, you can't sell your house if it's underwater without bringing cash to the table. And their definition of seriously underwater is at least 25%. So we have 25% seriously underwater, which is problematic for a lot of people. What they don't say, and which to me I always wonder, well, what about just underwater? So what about 1% to 24%? How many homes are underwater in that capacity? Because technically you are. And when you take a look at how things work, well, if you were to put your home for sale, that's why when we hear all this, we got all this equity, sell your homes and get rid of all your mortgage and financial problems. Well, if you're in that 1 to 24% underwater range, realize that, if you put your home on the marketplace, you're going to have closing costs, a few points there. You're going to have commissions, usually 5 or 6%. So you're talking 8-9% off the top, off your price when you close. So what are you left with respect to equity, right? And can you? So if you're underwater, you really can't do that. Now, don't forget all these people who are facing forbearance. Even though they're not paying their mortgage, they're still chipping away at the loss of equity. So that's why as time goes on, and we're approaching a year's worth of forbearance now at the end of March. All the equity that maybe is perceived out there may not be really available as some are stating. So that's the whole point. So really, the largest decline in underwater property spreads across the South. I'm going to put the link into this. San Francisco area dominates the list of the top equity-rich counties. I'll put the link so you can look at this yourself. But it boils down to, the typical locations are growing with equity. The typical other locations, have the underwater stuff. So that's how this rolls out here. We can take a look at what we got here. The top 10 states with the highest shares of mortgages that were seriously underwater in the fourth quarter were all in the South and Midwest, led by Louisiana, Mississippi, West Virginia, and Arkansas, all over 10% of mortgages being underwater. The smallest percentages were in Washington, Oregon, California, Utah, and Arizona, all under 3%. So there you go. The most seriously underwater locations, metros in the fourth quarter would be Baton Rouge, Louisiana, Syracuse, New York, Youngstown, Ohio, Toledo, Ohio, and Scranton, Pennsylvania. So, that's the situation we're kind of in right now. As I said, some of these locations still are hurting. At least 25% of all properties were seriously underwater in 81% of zip codes. So zip codes in Cleveland and St. Louis have issues. And we do know that certain like Cleveland, for example, has a lot of zip codes, a lot of, foreclosure homes sitting around there too, St. Louis as well too. So certain locations are going for whatever economic and job-based and industry issues are going to have more than others across the country. So simple as that. We talk about this every quarter. Let me go on to the next slide here. All right. One of the things I do want to show you here is that obviously we're seeing equity in rich improvements. So this was Q3 2020 on the left, and this is Q4 2020. So you can take a look at certain zip codes. They're saying the top U.S. zip codes are the biggest improvements in equity-rich share of homes in Q4 2020. So you've got Huntington, West Virginia, Oxnard, California, Fort Lauderdale, Florida, Joliet, Illinois, Inglewood, California, Glendale, California, looks like Capitanera, California, Bloomington, California, Inglewood, California, and Santa Maria, California. So the majority of West Coast locations are the ones that are increasing with their equity. So great for those zip codes if you want to sell, tough if you want to buy. But you can see that there is improvement in locations, but most improvement is in the West Coast. All right, if we get deeper into this, which is certainly kind of important as I talk about this, my concern is that there's stuff going on behind the scenes, and this is all fluff, and everything sounds good, but what's really happening, and where do the economists see things at? So home price surge says inflation is real. The Fed clings to illusion it isn't. So that's been part of the discussion as well too, that we've got home prices and they're inflationary. So they're outpacing inflation, outpacing wages, the whole bit here. So central bankers routinely deny any connection between their monetary policies and asset prices, even though that's how these policies are transmitted into the real economy. Pay no attention to the man behind the curtain, they all insist. As lightning and smoke jumps and hisses while they manipulate the controls, believing that they're shrouded from view. So it wasn't surprising that Federal Reserve Chairman Jerome Powell, at his recent press conference, pointed to other factors for the rallying stock market, including the convulsions in names such as GameStop and the expected positive effects of the COVID-19 vaccines and stimulus. He called. We're talking about. But when asked about the housing market, specifically the jump in prices and what pace of increase might induce a change in the Fed's $40 billion monthly purchases of agency-backed mortgage securities, Powell demurred from connecting the two. He called the double-digit annual surge in home prices a passing phenomenon related to the pandemic. There's a one-time thing happening with people who are spending all of their time in their house, and they're thinking, I either need a bigger house or another house and a different house. So on a second house in some cases, or a second house in some cases, so there's a one-time shift in demand that we think will get satisfied. Also, that will call forth supply, and we think that those price increases are likely to be sustained for all those reasons. So, okay, well, that's his perspective, but we're not seeing, he's calling forth supply, but we're not seeing supply. Where does supply come from? Supply comes from people moving up or moving down in homes. And with low inventory and high prices, how are they going to do that? Low, supply comes from home builders. Well, home builders can't build at the pace and at the price points that we need. And a lot of supply could come from the distressed market, which doesn't exist because of the foreclosure and eviction moratoriums. That will happen this year at start, and it will happen pretty hard. However, that's not being factored into what he's saying here. And now this came out here. This is produced by the American Enterprise Institute, which I think does a really great job with respect to analyzing the market from a very unbiased perspective. And he's basically saying here, look at the home price appreciation, HPA. So this is up from 10.2% a month ago and 6% from a year ago. So due to low mortgage rates, the HPA is projected to accelerate to the 13 to 14% range in January, February, and March. That's out of control. Number little two there. Low rates are driving high HPA growth across all price tiers, from the low, medium, medium high, and the high price range. Historically, HPA in the lower price tiers have far outpaced HPA in the upper price tiers. Reason being, more people can afford the lower price tiers. Well, basically with lower interest rates and lack of inventory, we're seeing other people, maybe your buying powers increase with lower rates, so you're moving up into higher tiers. People may be cashing out in other locations and buying other locations from a higher tier point as well too. So we're seeing some movement that we haven't seen with price points in quite some time. So They took a look and said the home price appreciation varied significantly among the 40 largest metros in the U.S. In all metros, home price appreciation was at least 6% or higher from a year ago. So at least 6% in the top 40. So your lowest HPA metros are New York City, Northport, Florida, Houston, Texas. Your highest HPA metros are Phoenix, Philadelphia, Washington, Seattle, Washington. You can see the colors. So obviously the blue is the lower, which is still 6%. And the we got almost 15% being the sort of like dark red, which would be Phoenix. So you can see what's happening. Home prices are responding to sharply lower interest rates and the lower months remaining inventory for new and existing homes, with all three states at the lowest levels, all three series at lowest levels in history, said Edward Pinto from AEI. So really lower interest rates, lower inventory, everything happened at once. And due to low rates, the medium, high, and high price tiers, which are more dependent on mortgage rates, are showing the strongest rates of appreciation. This is a trend reversal from earlier times, stating Tobias Peter from AEI. So, as I mentioned, I really like the information these guys produce. It's very informative and they're very accurate. So, their perspective is the Fed's monetary punch bowl is fueling rampant home price appreciation. I actually did a video on this probably back around probably the time that they're saying here. Attendees at our July 29th, 2020 briefing were the first to learn that HPA was quickly accelerating, heading to the low double digits in late 2020. Preliminary national rate of HPA for December was at 11%, up from 6% a year ago. In the third month, they're near at low double digits. Nationally, the HPA is ticked up again due to lower mortgage rates after having increased by 116 basis points in September 2017 to early November 2018. Rates have declined by 217 basis points. Optimal blue data indicate that the rate of HPA will further accelerate over the coming months. So we can see that the graph on the left shows the 30-year fixed rate mortgage declining rapidly, and you can see that the graph on the right shows the year-over-year rate of home price appreciation. The blue line, tracks the appreciation. The red dots are showing you the December demarcation point per year because they're looking at the December information. You can see that the difference. We've gone up, from the, you can say middle of, July-ish, summertime to where we are now. It's pretty significant in home price appreciation. So they're saying that this is problematic. And if you really look at or read what economists and analysts are saying, as opposed to the hype out there. And the hype is not just jobs, okay? I mean, jobs, but it's almost like we're on one hand, we say we're getting more jobs. On the other hand, we show that we're losing jobs as well too. So, I think it's just a big shift of what's happening with people. So the issue is that what they're saying is that, is the Fed misdiagnosing the impact on the housing market? So their view is that the significant price increases we are experiencing represent a one-time shift in demand that we think will get satisfied, and those prices aren't likely to be sustained. So as I go back a couple slides going, well, okay, how will that demand be satisfied? So we don't see home builders building 4 million properties this year, and we don't see if AEI is calling for continued appreciation because of the situation we're in. I don't see it doesn't seem to make sense, you see. And then they're saying that their analysis does not appear to take into account the following: arbitrage opportunities due to the interplay between work from home and long-term price distortions from zoning and land use regulations constraint supply. The Fed anticipates growing demand and will call for supply and price increases will be a passing phenomena. This has not occurred on states like California, which has the highest nation's home prices and the most restrictive land use provisions. New supply is being added in states in the South and Southwest where land provisions are more sensible. And that means cost of land, cost of development, maybe flexibility in zoning and things like that. While the Fed notes the housing market is experiencing significant home price increases, it's unlikely to be a passing phenomena for move-up and first-time buyers. So clearly, if you're looking to sell your smaller home and to move up to a larger home, you're going to be paying for first-time home buyers every month. It's tougher and tougher to get in to purchase homes. That's the segment that's going to be hurt. Year-over-year home price appreciation is exploding with no end in sight. The goal is to maintain the current 0 to 1/4% funds rate as to achieve general inflation moderately above 2%. Median high price bins, think move up buyers, we're looking at 15 and 13% up respectively. Default risk is low due to minimal leverage and the added buying power from the work from home group. The arbitrage opportunity presented by moving to further out areas within a metro or to less expensive metro will likely take many years to play out. Low and medium bins, think first-time home buyers, up 13 and 11% respectively. They are much more highly leveraged and work from home presents fewer opportunities. Since the top 40 metros have HPA increases of 6 to 14%, affordability continues to worsen even in places that used to be more affordable. So what he's basically saying is that the low to median vertical sectors for housing, they're much more leveraged and they're going to be more susceptible to having issues facing the affordability. So with the housing sector has more, this is again quoting Powell saying, the housing sector has more than fully recovered from the downturn. What AEI is saying is that there is no justification for continuing any or increased investment in agency mortgage-backed securities, but they're buying them like they're going out of style. They're roughly $40 billion a month. So why are they doing this? So obviously, they're stimulating the economy. They're creating this impact on housing, and I don't think it's going to end very well. That's everyone's point here. So as we go forward, we take a look at the market fundamentals and how it's not, since 2012, home prices have appreciated about 2 to 3 times the rate of market fundamentals. Since fundamentals ultimately underpin prices, this is unsustainable over the long run. While this is unknowable for how much higher prices will rise or when the cycle will turn, the longer that higher prices deviate from fundamentals, the more painful will be the eventual correction. So this is exactly bubble theory, like I call bubble theory, housing bubble 101. So the longer it goes, the more exponential it increases, which means the more painful and destructive will be the eventual correction. Going back to the housing hype people, there won't be a correction because of all this equity. Well, you know what? When you start taking a look at numbers behind the scenes, and listen, we can look at everything is good, jobs, whatever. You've got what I call real analytics going on here from people who are smarter than most of us, right? Putting this stuff together, we see that the HPA growth is on a higher trajectory than the CoreLogic construction cost quarterly index, the Bureau of Labor and Statistics wage index, and CoreLogic's single-family rent index. So you take a look at, those are all modest growth, and yet home price appreciation, as they're saying, outpacing it by 2 to 3 times. So that's unsustainable. That'll cause problems, and our problems are bubbling like a geyser, like a volcano. There's pressure building. It's going to happen. It's being put off, and delayed, which is problematic for all of us. So what they did here is they said home price appreciation, the largest metros, has picked up nearly across the board compared to December of last year. Orlando was the only metro in the top 40 with lower HPA than 1 year ago, and only barely. Phoenix continues to set the pace for HPA since year-over-year increases of 6% up to 14% are occurring in all 40 metros. Affordability continues to worsen, even if in places that used to be more affordable. So really, if Orlando is just below that 6%, it's still increasing. I look at Orlando. What's Orlando got? Tourism, Disney, all sorts of stuff going on there. That's probably affected the most with COVID and the pandemic, etc. But every other place is growing leaps and bounds, and you can take a look. Everything's above the faster HPA than a year ago versus slower HPA than a year ago. So everything except Orlando is faster with home price appreciation. So it's there, it's happening. Where it's going to top out, nobody knows except for a few people. So when will this ride end? So I guess everyone wants to know, when will this ride actually kind of end? All right. So when I go back to the other video, forbearance, is coming. The first forbearance wave is coming to an end. We're going to have roughly 600,000 people, seriously delinquent borrowers are going to fall out of forbearance plans. How that's going to play out, we don't know. Will the Fed do something? Will the HUD do something? FHA do something? Or FHFA? These lenders can't go on very long doing this. So we've got basically, we're talking 600,000 people, expiring. And I haven't talked about that this week. There's too much to talk about. But if you take a look at, what did I see on forbearance? Oh, forbearance numbers look good. Why do forbearance numbers look good? Because of plan expiration. So people were expiring. What we typically saw with plan expirations, where the majority of those people, 80+%, would re-enter forbearance. So things look good this week, but may not look good next week. So please make sure that you're taking that into account when you're looking at all this. And, I'm going to keep playing these slides over and over again because these slides hit home, all right? And it talks about what's going to happen here. Single-family rentals, the biggest asset class. Operators are competing for land. Lots of stuff going on here. Builders are now doing rent-to-own for big hedge funds. Other investors are looking for properties to make rental accommodations and fix and flip. So everyone's buying, okay? And I don't profess to say buy at the top of the market, but buy distressed, buy well, and you can make some money or get a decent price property if you're looking to do that. So I show this slide quite a bit here. It's about the AdamAuction.com saying, well, here's this the number of foreclosures we predict. And they've been adjusting that to 2.5 to 3 million, also 1.1 plus million delinquencies, not any forbearance plan, exposed to foreclosure. This came out via Black Knight. We're talking about almost 3.5 million properties that are in delinquent and or in foreclosure. So as I always mention, equity is not going to solve 3.5 million problems, and I can probably tell you that a lot of the data is most likely going to be underrepresented. So it's worse than we really believe. Now, some of the things that when and talking to this guy here, short sales, other pre-foreclosure sales are poised to become a more dominant share of the distressed market in 2021 and beyond. They're going to be part of the equation to help homeowners and also get yourselves decent priced property comparing to where the market is. 1% of all on-market property sales fall into this category. As I mentioned, go to foreclosure.com and you can see in any city, county, state, you can see the volume of what's going on there. Our distressed properties, REO sales and short sales. No one's doing short sales. How do we know this? Because we can take a look at the MLSs and when National Association of Realtors puts out their information. 1% of all sales across the board is distressed. That means less than 1% are short sales out of that component. So foreclosure filings are quietly increasing. More properties are scheduled for a foreclosure auction. As I mentioned, go to foreclosure.com or my Get Housing Data link, and you can check out what they have as far as opportunities, and we're going to start seeing more of those. Think the 1% rule, as I mentioned. Here's my point, though. We're fighting the housing market. So I a number of months ago, I'm like, what? I can't personally change it, neither can you, but we can work around it and we can figure stuff out. And that's the beauty of being a feet in the street and knowing what's happening in the marketplace is we can manipulate. So I've stopped fighting the housing market. I still know what's going to happen. I talk to analysts, economists, real estate attorneys. I talk to asset managers behind the scenes, and I can tell you that they know what's coming and they're just trying to milk what they can as to what they have, because they realize that they're going to have a lot of underperforming assets in the next little while, and they're preparing for that. So the lenders know what's happening. It's mainstream media, and I call it the housing hype people that are out there that want us to believe that we're not going to have any problems. I don't care what they say. I don't, it doesn't bother me because I see it in the marketplace. I know it's going to happen. I'm pretty confident about that. And it's not just because I'm dreaming this up at nighttime here. I'm talking to a lot of people. I'm getting their perspective. The billion-dollar investors all have that we call dry powder. They're waiting to deploy. They want to wait to see things crack before they buy. A lot of other prolific investors that I know, same thing. They know what they're doing, and they're preparing for that. They're basically that's what I'm looking for. They're, every so often they cull 10 to 15% of their, we'll call it inventory, to cash raise, knowing that there's going to be better deals coming the next little while. So this is what's happening behind the scenes with people who really know what's going on in the industry as opposed to just mainstream media. So I look at it going, ride the wave, select a local market, get control of a distressed property, earn money, just figure something out. I can certainly help you with that. There are a lot of opportunities happening down here in my market. And as I said, www.gethousingdata.com to look at the foreclosure stuff that we have out there. So want more information, I'll tell you about it. Just connect with me. I'll be hitting this week back on. I was sort of off a little bit last week doing some things that I had to take care of. I'll be back in the saddle this week. So reach out to me. We'll go from there. A lot of stuff happening. Reach out and we'll figure stuff out on the fly here. So again, thanks for the views, likes, comments. Believe it or not, everything is all relative to today's market. So things may seem out of reach, but things will change in the next little while. Mark my words. I'm relying upon the information I get from not the media, from other sources, and I think that's a lot more solid than what we're seeing on the internet and in newscasts. All right, guys, take care. Look forward to talking to you later on this week.